Good evening, everyone. I hope you are all well. This is a second lecture, which is a recorded version. Actually, what happened when we were recording last time, there were some glitches faced by activity, like some, backend and like the Zoom. So the recording was not possible. The class stopped in between. We though continued our class. It's just that the recording was not available for the entire thing. So what we are doing right now is a reshoot. Whatever we try to discuss during the class in second lecture, we are trying to reshoot it for you. In this lecture, we mainly will cover chapter number one. Chapter number one actually completed in third lecture. Okay, in the initial of third lecture. So I will try to cover as much as possible in chapter number one. Maybe we will finish the chapter number one in this recorded lecture, and in the third lecture, you can skip that part. So basically, let's see how it goes. Because normally I am familiar, basically, into the habit of getting talking to students. Right now, I'm just recording to myself, so it seems little different. So let's see how it goes. So chapter number one, introduction to audit and assurance, what we discussed in the class. Basically, in the first chapter, after getting an introduction to the, okay, I think one student has joined, just wait. Just a second. Just a second, no? Fine. Starting now. So in the after basically we were already discussed the introduction to audit in our last basically class, and we started with the chapter one, introduction to audit and insurance, where we discussed the difference in what is audit, what is insurance. Insurance is a big umbrella, right? We discussed what is a practitioner, what is intended user, with this responsible party. And there we basically talked about that the example of builder and the basically the engineer, where a customer wants to buy a building and they will take a help of the engineer, because whatever is builder is selling to them, they are not sure whether builder is actually telling the truth or not. So just to get a confirmation, they can take the third party, a practitioner, a expert opinion on the purchase, and basically the third party will review the work done by the builder. Okay, and here they will be basically providing their expertise. Whether to buy or not, that will be the decision of the user. So this is what we overall discussed in the last class. We went on discussing the element of assurance engagement, the criteria, report, basically the evidences, subject matter, three-party relationship. So in this, we basically discussed all these factors. Basically, criteria is what that, let's say, builder has created their building. So what are the parameters that the engineer would be checking? That would be the criteria. The report that engineer will be issuing to the customer. So report will be addressed to the customer here. Evidences that engineer obtains when he basically verifies all the thing done by the manufacturer in this case. Subject matter would be the building, of course, and then three-party relationship. So these were the elements of the assurance engagement, which we discussed in the first class. This was activity one. And then there were some example of assurance engagement, statutory auditor, review of cash flow, basically entities, financial statement forecast for 1 year. These are some examples. Whereas external audit or statutory audit, which we do as per compulsory requirement, is a basically reasonable assurance example. What is reasonable assurance? What is limited assurance? That we touched in the last class, right? So review of cash flow. Let's say cash flow is what you project about the entity for next 6 months, next 1 year, next 2 years, next 5 years. So that is just a projection, an estimation. So we try to review it. It's definitely a type of a limited assurance, not a guarantee here. Review of entities' financial results, basically first half year, let's say interim audit, review of threat that could affect business ability to continue as a going concern. What is a going concern? That entity's ability to continue for next 12 months. Okay, that is what we discussed in the last class. And entity's effectiveness of internal control. Internal control is a very significant component in your syllabus, and which we will be discussing in chapter number 10. And this is what we are going to study further. So management can ask auditor to review their internal control for them. And this review can also be part of a insurance agreement. One internal control review will be in your statutory audit, which you will do for your audit purpose. Second, that management can ask you separately. In statutory audit, your purpose is to provide opinion on financial statement and not on internal control. You just use internal control for that purpose of financial statement. But here, if management asks you for checking the internal control, that could be a separate assurance engagement. Okay. Benefit of assurance engagement, one of them is that third party is always independent. They are not biased towards the management. They enhance the credibility. They basically, they can draw the attention of, let's say, users. Users can be customer, user can be shareholder, employee, government. They can bring the attention to people by saying that, okay, if something is going wrong, if they give an unqualified opinion, or let's say, a good opinion, unqualified opinion or a good opinion. What is unqualified opinion? That entity is doing everything. I know the word sounds incorrect, that why it's unqualified, but that is what we will discuss in chapter number 20. Okay, that we discussed in the last class. So if they issue unqualified opinion, then everything will be fine. But the moment they issue a qualified opinion is a very bad thing in audit. If you get a qualified opinion, suddenly everybody attention will be there. Like, how did you get a qualified opinion? Shareholder, basically the government, the supplier, bankers, everybody will be paying attention, like what has happened wrong. So this can be a qualified opinion. Relevant information is improved. Basically, information become more relevant if it gets audited because it's now credible. People can rely on that information, right? Because this information has gone through an expert knowledge. So we discussed about the ability to continue as a going concern in the last class. We also basically saw an example that how one person holding entire role of cash, let's say cash collection, how their role is split can basically create a better control. If there is no splitting of role, in that case, entities controls are there. So we were explaining this review of control. As I told you, this is basically, I skipped this in the last class, and for the timing till we cover chapter number 6, we will continue to skip it because this is your entire audit syllabus. And if I start this right now, I will have to explain each and everything. What is scope of work? What is formalization? Basically, engagement letter. This is covered in chapter number 5. What is planning, audit, and risk assessment? This is basically chapter number 6 and chapter number 7. Obtain sufficient appropriate evidences and drawing conclusion based on them. Chapter number 8 and basically chapter number 9 also. Subsequent events. This is covered in basically chapter number 17. Overall review, opinion, chapter number 17. So it's a basically this single line are basically entire audit syllabus. So we skipped this in the last class. And for the timing, but once we will be through with the entire syllabus, we will definitely come back on this slide. Then we discuss basically scope of work, intended user, subject matter, responsible party practice, basically the element of the assurance engagement. Planning, risk assessment, test of control. Okay, and let me skip this. So these were the last piece which we discussed in the first class, and let's continue that. There are two levels of assurances. First is limited assurance, and second one is reasonable assurance. Reasonable assurance is a high level assurance because here we check more detailed transaction. Here we check transaction in more detail. Whereas in limited assurance, this is basically a less level of assurance. It's also known as a negative assurance. Negative assurance. Basically, I try to explain this with this example. Let me just add my screen here. What we were discussing that in negative assurance, you need to remember this word negative, positive. Okay, negative, positive. So in negative assurance, or let's say in the limited assurance, we try to say that okay, I have not found anything, negative. I didn't find any mistake. So the purpose of limited assurance is, very minimum. That here you are trying to see comparison with the previous and try to find any deficiencies, whether there was any significant, variation which could have impacted negatively. So you are trying to only find the mistakes in the limited assurance. You are not focused on the overall well-being. Okay. Let's say gather sufficient appropriate evidence to draw limited assurance. What is limited assurance? That we do fewer procedures. We mainly inquire, we do analytical procedure. Analytical procedure basically is one of the important procedure of audit. Let's say comparing current year sales number with the previous year sale number. Okay. Or let's say comparing current year sale number with the budget sale number. So we try to see any difference here. Okay. We mainly inquire the nature, timing and extent. Basically, the amount of procedure we do is very, very limited. So it's basically finding any negative point in the organization. That's why it's called a limited or negative assurance. So if let's say you are issuing a report, what do you write in a limited assurance? Nothing has come to our attention. Nothing has come to our attention means nothing negative has come to our attention that made us believe that financial statement are not prepared in a material respect as per applicable authority. I know this is a very technical line, but the purpose we are trying to say here is that, let me just simplify it for you, that financial statement doesn't have any material misstatement. That is what we are trying to say in limited assurance. On the contrary, if we talk about reasonable assurance, what we are saying here, we try to do thorough procedures. Thorough procedures means not only inquire, not only analytical procedure, but checking, inspecting invoices, basically, getting third-party confirmation, trying to look for the trail of the transaction. We are going in one step detail. We are going, much detail. We are testing the test of detail and substantive procedure. These are basically way to check financial statement items, let's say balance sheet items, or let's say P&L transactions. We try to check them in detail. If I have a revenue reported in my P&L, I will be going basically digging them deeper and trying to see whether they have invoices, whether they have GTN, whether this was ordered by customer. So I'm going one step layer, trying to confirm whether that sale actually occurred, right? So this is more detailed procedure. So in this, what we do in the reasonable assurance, we try to basically give a positive opinion. What I mean by positive opinion, that we try to see whether financial statement is basically true and fair. What, let's say if we test something, if we check something, then we say that this was a good financial statement. Now, finding something negative is one thing, and telling whether something is good, is another thing. Because if you are telling me that okay, that this statement is actually good, it means that not only you find the mistakes, but also you also evaluated its fairness, you also evaluated its accuracy. So you are giving a better confidence to this statement. Here you are not confident, you are just saying, see, I'm not sure whether this is good, I'm only saying I didn't find anything negative. But in this case you are saying that see, I am very confident about these statements. So this is reasonable and this is basically limited. Reasonable assurance is a positive assurance. And here we try to check things in thorough. And that's why we can give a more confident opinion about them. In limited assurance, we are checking limited transaction. That's why we give a limited view of them. Right? So this was your limited and your reasonable assurance. The two type of assurance. Just to let you know, audit, the statutory audit that we do is basically a reasonable assurance. Okay? So these are the two assurance which we discussed, and then we went on discussing the separation of ownership. So this is where the second lecture would start actually. Let me just also add here. So, right. Auditor's opinion, materiality, reasonable assurance. This was assurance engagement till chapter number one, assurance engagement, element of assurance engagement. This was also one activity. Example of assurance engagement, approach, benefits of assurance engagement, level of assurance. So far we have discussed this piece. Now discuss the chapter number one. Basically, what is the objective of audit? What is the accountability, stewardship, and agency? Let's discuss this piece now. So, in order to understand the separation of ownership, control, or let's say what is accountability, stewardship, and agency, and why this audit is basically formed, we have to go back and basically take a step back and basically understand how limited companies are formed. What is the purpose of a limited company? Okay, so let me just show you. Why limited companies are formed, or what is basically the purpose of limited company? A limited company basically has two main features. Two main features. Feature number one, that it has limited liability. And second feature, that it is a separate legal entity. This is maybe you have covered in your business and technology subject, or you may have this don't pry or commerce education. Separate legal entity. Now, what this creates? A limited liability basically gives the owner the limited liability. What do I mean by that? Let's say a company has 10 crore assets and it has a debt or basically liability or loan of 15 crore. Now, if you sell this company, you will be able to fetch 10 crore. This 10 crore payment will be going in 15 crore and you will be left with 5 crore basically debt. Now, because this is a company, the lender or the bankers, cannot come and go. Basically, let's say these are the shareholders. They have opened this company, let's say ABC Limited. So now this lender cannot go, the shareholder, let's say this is Mr. A, Mr. B, and sell their private property. Sell their private property. This is not allowed. Let's say their private property is 20 crore worth. But the lenders cannot do that. Why? Because company ABC Limited only had 10 crore worth of asset. So because of this limited liability, the lenders cannot touch the shareholder. Okay. And because ABC Limited is a person in eye of law. Okay, though it is not an basically actual person, the company is just in the documentation. But in the eye of law, a limited company, a company is an artificial person that exists in the eye of law. So company is a separate person. Basically, company can run business in its own name, get into a contract, file a case, basically, exist in its own entirety. So it's a separate legal entity. That means the company is different and their owner, Mr. A, Mr. B, they are different. Now, because company has this limited liability, it gives them a very big power. Okay, because let's say if I have an intention of frauding people, so what I would do? Today, I will open up company, let's say XYZ. Okay, I will put, let's say 10 lakh rupees here and I will go to bank and ask them to give me 1 crore rupee loan. Maybe I will convince them somehow, anything I will do, and I will convince them to give me this 1 crore. Now, as a company of XYZ, I am Mr. X, the owner of this company. Okay, I am the shareholder of this company. Now, loan is basically in the name of company. Now, what I would do, if I have an intention to fraud, I will use this 1 crore and buy my property, buy car, okay, and that will be in my name. That will be in my name, not in my company. But loan is taken by the company. Now what will happen if tomorrow bankers come and ask for payment from me? I will show them, see, this is a limited company. Ask the company because loan is taken by company and not by me. So in this case, I have more chances to deceive the bank because now bank can only recover 10 lakh and not 1 crore because XYZ only have 10 crore of assets. So you can see the limited liability gives company a immense power. Immense power. Now, definitely, I know that why would company be allowed? Can company not be sued? Yes, company can be sued if it gets into any illegal activity. But I was just trying to show that how limited liability gives immense power to the company, right? So in this case, company has a limited liability and a separate legal entity. So it's a very, very powerful power to the company. Now, what separate liability does? That if owners are different, now let's say Mr. A in this case or Mr. B in this case doesn't need to run the ABC. Company will be run by employees known as directors. In the Companies Act, it is a requirement that directors are the only people who run the company. Let's say they are shareholder, they don't need to run the company, only directors can. Now, definitely, they are the shareholder, they will be the one who will appoint directors. So they can appoint themselves in the capacity of employee. That let's say Mr. A will be the director of ABC Limited. Just to give you a context. Elon Musk is the owner of Tesla and SpaceX. So he's the shareholder of the Tesla and SpaceX. But at the same time, he's the director or CEO of the company of Tesla and SpaceX. How? Because he has invested his money in SpaceX. So definitely he's the shareholder, he's the owner. But at the same time, because he is the major shareholder, he holds more than 50% of the company. Just for hypothetical example. So in this case, he can basically appoint himself as the director or CEO of the company. That is the power. So those shareholders who have the power to govern the company, they can appoint their employee. And in this case, Mr. Elon Musk has appointed himself as the director. Let's say the Reliance company, their family owns, let's say, 50% more shareholder. Okay. In reality, they hold less, but right now, let's assume for the case that they hold more than 50% shareholding. So in this case, Mr. Mukesh Ambani has appointed himself as the director. Okay. He is the director, he is the employee of the company. So as the director of the company, he will run the company for the shareholder. Okay. He is basically acting as a director of the company. But at the same time, if we talk about shareholder, he is the owner of the company. So I hope that owner of the company and the shareholder of the company are basically two different, shareholder of the company and director of the company are two different people. They are separate people. Company is ABC Limited. It is run by its director as per Company Act. Company can only be run by its director. But the owner are the basically Mr. A and Mr. B. I hope this is clear. Because if let's say, this is ABC Limited, I have money. I am Mr. A. I have, let's say, 10 crore rupees. I have money. But I don't have expertise. Because of the company, I can appoint a director. I can appoint a director who will run the company to me. Now you may ask, let's say I'm an owner. I'm not a company. I'm an owner. Let's say I'm a sole proprietor. At that time also, I can also, appoint manager. Okay. And that manager would basically run the company for me. You may ask this valid point. But the question is that manager is directly reporting to the sole proprietor, and sole proprietor with him is also running the company. Okay. When company, let's say a sole proprietor gets filed a case, so sole proprietor is personally liable for his assets. His assets can be, sold. His personal car, personal property can be sold, and he cannot complain if the debt of the sole proprietor is not recovered. That is why he is personally liable. But in case of company, they are not personally liable. Their liability is limited, and that's why Mr. A personal property cannot be damaged. Only ABC Limited assets can be recovered up to that point. Other than that, beyond that, basically lenders or bankers cannot recover money. And that is why this director is different from this manager. Why? Because director is running the company, manager is running the company with the sole proprietor. Here, director is the only one who's running the company. Though their director reports to shareholder. Director reports to shareholder. Shareholder are the one who have invested the money, and now they will basically participate in majority decision. Sorry, not in majority decision, in major significant decision. If any decision director want to basically get approved, they have to take a shareholder approval. For day-to-day operations or for, what should be the direction of the company, that will director will decide, not shareholder. Why? Because they are the expert. That's why we have hired them now. Let's say the finance expert, let's say the IT expert. They are the people best judge about it. That's why we have hired them. But at the same time, shareholder will only invest money. They will only concern the matter themselves, which basically relates to their money, which can hamper the company's performance. Okay, let me give you some examples for this context. Before we go ahead, yeah, just for the sake, let's read this for a moment and then we'll come back. Accountability, stewardship, and agency. Oh no, this line I will have to explain. In a company, management act as an agent of the body of shareholder. What this line is saying, management slash director act as an agent of shareholder. They are accountable to shareholder for their stewardship of entities' assets, which are placed under their control. They achieve this by preparing financial statements, which are presented to shareholder. Most incorporated entities are legally required to have their financial statement audited through many smaller entities and are exempt from the requirement. Okay, so there are so many statements. Let's try to analyze them one by one. This is a case study. Vera decided to set up a business by selling flour. Okay. She gets up early in the morning, she visits the market and then set up some stalls side road. For the first year, all goes well and she sells the flour. Now she is able to buy and she drives some income from the business. So basically, right now, what Vera is doing, she is basically selling the flowers and earning the business. So right now, she is the sole proprietor. Okay, basically selling flowers and earning. However, Vera feels that she could sell more flowers if she was able to transport more basically places where she sells them, and also knows that there are several other roads nearby where she could sell flowers. Means Vera is looking at the business opportunity. She knows people like to buy flower. So if she has a car where she can transport the flower, she will be able to make more sales. At the same time, she is just a one person. So she is right now selling at one road. So there are other roads where she can sell her flowers. But for that, she needs employees. So she is right now looking at a business opportunity. If she could be in two places, meaning more employee required, she could achieve these two things by buying a van and hiring employees, like we guessed. So transportation would require car and basically getting it two places require more employees. Now what Vera does here? Vera needs more money to achieve this expansion of her business. Okay. She decided to ask her rich friend Peter. Now very important point. Vera is the sole proprietor earlier. Okay, she needed money. She needed money. What she did, she asked her friend Peter for the money. So now, if you look at the concept of the company, this Peter would be investing his money. So money is given by Peter. So here, Peter would become the shareholder. And Vera would become the director. Why? Because this shareholder have the money. Basically, Peter has money with him. But he doesn't know how to sell flowers. He doesn't know how to sell flowers. He likes the idea of Vera of selling flowers on multiple roads, but he cannot be sure. But he can't be sure. He can't be sure about whether or not basically people would like this idea. He can't be sure whether or not his business will be successful. Okay. Oh, no, let's not write such sure. Basically, he sees the potential in Vera's idea of selling the flowers at multiple roads, but he knows that Vera is much better expert in doing that. So let's open a company. Okay. Peter can see the potential of Vera's business and want to invest, but he doesn't want to involve in the management of the business because he's not a basically flower seller. He doesn't understand this. All he has got is money. He doesn't have the skill. Vera's got the skill. So he doesn't want to have a ultimate liability. Ultimate liability, a sole proprietor would have a ultimate liability because sole proprietor will be personally liable. He therefore suggests that they set up a limited company. Okay, he will own the majority of share. Basically, he will be the shareholder. Shareholder are those people who basically invest the money and be entitled to dividend. Basically, the profit of the company. Vera will be the managing director and be paid a salary for her. So again, because Peter has invested money, he would become the shareholder. Okay, let's say what is the name of their company? Okay, let's talk about Flowers Limited. Flowers Limited, and money will be given by Peter. Okay, and Vera would be basically coming there as the director, as the director. Okay, so here basically, just a second. Yeah. So she would be appointed as a director because she's an expert. It's much better to appoint her as the basically director. Whereas Peter would be just acting in the capacity of the shareholder. He would not intervene in day-to-day business. And Vera would be paid a salary per month, just like an employee. And as per Companies Act, only directors can run the affairs of the company. So at the end of first year trading month, Peter receives a copy of financial statement, which financial statement are prepared by Vera because she's running the company. If you are running the company, so director would be the one who prepares this financial statement, not shareholder. Shareholder receive this financial statement from director, and this is where our accountability, stewardship, and our basically agency issue would come. That there is a shareholder, there is a director, there is a company. Company is managed by directors. Director are the one who gets salary. Director are the one who will be managing the company. And they will be issuing financial statement. Financial statement include balance sheet, P&L, cash flow statement. And this will be issued to shareholder to report them what about their performance, to report about company's performance, basically how director manage the company. Okay, this is a kind of report to shareholder or other stakeholders. Other stakeholders. What are other stakeholders? We will discuss them. So what happened here? Peter received the financial statement, basically a report by the director. And what he saw that the profits are lower than expected. So when Peter invested, let's say 5 crore, he was expecting a 50 lakh profit. But he saw the profit was only 20 lakh. So Peter was concerned like why Vera was not able to sell basically flour. His dividend will not be as large as he had hoped. He knows that Vera is paid a salary and now he does not care as much as him that profit are lower. Why? See the statement. Peter, as a shareholder, believes that the Vera right now are not concerned with the well-being of the company. Why? Because let's say Vera used to earn let's say Peter invested 10 crore and the actor is getting let's say salary of 50 lakh. Okay. Earlier when Vera was selling flower, let's say she was earning 20 lakh. So that's why she didn't have money. She approached the Peter. Now she's getting a 50 lakh salary. So now Veera is already receiving 50 lakhs, so she has no motivation for running the company. She just appointed in her authority as managing director, but she's saying, okay, if the company basically makes 2 crore profit, so it's fine. But whereas Peter was expecting a 5 crore profit because he saw the potential in the business. But right now, if Veera is able to make 2 crore profit, so she's fine. Even if she makes 1.5 crore profit or 1 crore profit, she's still fine. As long as she's able to pay herself as salary and minimum return to Peter. Whereas Peter is concerned that why profits are not basically increasing, why Veera is not putting more effort here. And the obvious reason, Veera has received her salary. Now, what she is bothered about? She is earning more than what she was earning before. So why she would be interested in making Peter more rich? She would be interested in making herself rich now. So she has no purpose. This basically creates a concept called agency issue. This creates a concept of agency issue. What is agency issue? So far, I hope the story is clear. So far, the director will be the one who will be running the company or managing the company. Okay, they will just get salary. Shareholder are the one who people invest in the company and they will be getting the profits or returns. Because shareholders have pushed their money, have invested their money. So They are the principal here, basically principal, and they appointed director as employee, or I can say as agent. So director are what? Director are just nothing but the agent of the principal. Now, shareholder expect director to be steward. Steward. What is steward? Basically, steward is derived from this concept. You can see a person who's looking this as a formal like a waiter. Or if I give you an example of how steward word was arrived, if you go in a five-star hotel, there will be stewards sitting out, basically waiting outside for to get off your car, and they will basically or basically you know them as valet. These people will be taking care of your car and basically kept them in the parking car until you take your dinner, and after you come back they basically give you a back car. So this concept of stewardship actually came from here, that they would be taking care of your car, taking care of your car the way it is their own. It is their own. So this stewardship theory says that director are responsible for managing the company as their own. Okay, they are supposed to basically put effort in the company as much they have put in their own money. That is basically the stewardship theory says. But there is a contradictory theory, which is an agency theory. That because principals are shareholder, they have invested money, and director are just merely agent. They are only concerned with their salary and bonus. So they are not concerned with the well-being of the company. And because they are not concerned with the well-being of the company, this creates an agency issue. You can see I have given Mr. This is a basically Matrix movie. This is called Mr. Agent Smith. So I'm trying to compare here director as Agent Smith. They are, very bad people. They are agents of the Matrix, but they are the one who basically creates virus. Just a reference, those who know Matrix movie. But if you don't, so the purpose here is that director are the people who are the agent of the company. Okay. They are expected to run the company basically on behalf of their principal, but because they prioritize their interest. They prioritize their interest. Okay, let's say receiving salary. So the shareholder interest, basically getting maximum profit. This creates a clash between director and basically shareholder, which is called conflict of interest. Conflict of interest. The director is only concerned with their salary. Shareholders are concerned with their profit. If director receive their salary, they have no motivation to run the company. And again, this create a conflict between the interest of the director and the interest of the shareholder. So this is an agency issue. Huh. So I hope I was able to explain the director relation and basically shareholder relation, and how shareholder and director relation creates an agency issue. Okay. So accountability, agency, and stewardship. Let me just bring back in. Read this line again. In a company, management act as an agent body of the shareholder. Now I hope you understand this line. Shareholder are the one who have appointed the director, because company can be run by director. And here director are acting as an agent of the principal or the shareholder. Okay. They are accountable to the shareholder. So the way director run the company, they are accountable to the shareholder, the owner of the company. For the stewardship of entities assets. What is stewardship? That they basically manage the company's assets. They basically safeguard the company's asset. They do not misuse the company's asset. They do not basically, misplace those assets or show carelessness. They exercise their stewardship in the same manner as if their own. Okay, so they are accountable to shareholder, and they are supposed to exercise stewardship. Now, coming back to our assurance. Okay, why basically we have done the assurance? Why we are doing audit or assurance person? Basically, you can see that shareholder will get a report, which report normally will be financial statement. basically balance sheet, P&L, cash flow statement, notes to account, statement of changes in equity. Okay, that you might have heard in your financial accounting or your financial reporting that you guys already know. Now, what will happen? Shareholder will get this report from director. Director are the one who's running the company. They are the one close to the process. Okay, they know the reality of the company. So they report this to shareholder to show how well they have managed the company, how well they have managed the company. They have managed the company. Now, in order to get a reliability, on this report, because this report is prepared by director. What if directors are telling lie? Okay, what if they are manipulating this? Let's say, in order to incentivize director, we provided them bonus. That let's say if you achieve 10 crore profit during the year, we will give you 1 crore bonus. Okay, if you give them 10 crore profit for the year, company achieves 10 crore profit, we will be giving them 1 crore bonus. Definitely now director will be interested in the profitability of the company. But what if it leads to a incorrect motivation? Let me show you how. In order to achieve profitability, okay, let's say entity basically needs to do what? Sales less purchases or cost of sale. Okay, cost of sale. And this should be basically their gross profit. Now, if entity achieve this profitability, what if director report fake sale? What if they in order to reduce cost, they fire employee? Because let's say if you fire your employee, you may save your basically cost, and because cost is reduced and sales are high, in that case profit will be achieved. But that is for temporary period. Now, if your skilled employees are fired, then who will basically bring the profitability of next year? You need to spend money on your employees so that they can continue to work for your company and later on generate revenue. So if directors fire those employees, in that case, maybe you achieve profitability for short term, but what about long term? So maybe director, if wrongly incentivized, their action can be deteriorating for the company as well as shareholders' well-being. Basically, shareholders' wealth, they will deteriorate the shareholders' wealth for the sake of short-term profitability. So whatever director is reporting here, it's need to be checked. It need to be checked by a third party. And here comes the insurance. So this third party would be what? An expert. So remember, expert or a practitioner who will be checking the basically information for users. Users are shareholder, who will basically subject matter would be the financial statement here and prepared by the management. And practitioner will provide assurance that whether these financial statements are reliable, so making financial statement credible. Yes or no? This is what basically the assurance engagement is about. And this is what the auditors will do. Auditors, in this case of company, auditor will come as a practitioner. They will audit this report, try to verify, because they are expert of financials. Okay, they expert the business, they understand the business. So they will check the balance sheet, P&L, cash flow. They will verify these numbers and report to shareholder. See shareholder, whatever directors have reported, is this correct? Or whether this is incorrect. Based on that, whatever shareholder would want to take a decision, they want to remove the director, they want to appoint another director, they want to invest in the company, they don't want to invest in the company, or basically other stakeholders can take decisions, supplier, banker, government, all will be interested in this report, which is basically checked by the auditor or a practitioner. I hope this is clear, the purpose of audit and how this basically goes around, right? So now read this. In audit provides an assurance. Assurance means basically a credibility about financial statement. An audit assurance provides assurance to shareholder and other stakeholder. What are other stakeholders? We are just going to discuss. Just to give you preview, employees, basically supplier, customer, basically government, local authorities, or local public. So there are multiple stakeholders. Major ones are basically shareholder, bankers, lenders, supplier, or customer. These are the major ones. These are the ones who are providing their money or basically depending on the company's product. But the other ones are basically, let's say, employees, or let's say government, or let's say local community. So an audit provides assurance to the shareholder and other stakeholder of a company on financial statement. So this is our subject matter, which we will be testing, and for the user of shareholder and other stakeholder. And because auditor is an independent and impartial person, why? It's a third party, and third party is an independent person. They have no concern with the director or basically with the shareholder. They are just there to provide their opinion. So the important parts of audit that they are independent, they are unbiased, they have no relation with director or no relation with shareholder. They are just there to give the opinion. They are basically acting as an agent for the shareholder. So you can see there will be two agents. Company is owned by the shareholder. Just look at this chart. Company is owned by the shareholder, okay, and managed by the director or management. We call director as management also. So company will be owning by shareholder and managed by the basically management. This management is basically appointed by the shareholder. Shareholder are the one who basically appoint the management. Management, in order to show their stewardship, they prepare the financial statement because shareholder doesn't know what is going on in company. So to know what is happening, basically management provide them financial statement to shareholder. Okay, this happens in annual general meeting every year. That every year the shareholders basically come and see basically what has director done. Let's say Reliance basically holds the annual general meeting. Mr. Mukesh Ambani basically comes as a director and present the report to entire shareholder. He is one of the major shareholder. Let's say he's 50% holder, 51% holder, but they are 49% shareholders also now. So for them, Mr. Mukesh Ambani comes as a director and represent them. Okay, this is the financial statement prepared by the company, right? And this financial statement will tell about the performance. Now, whether these financial statements are accurately prepared, correctly prepared, not misinforming, not misleading. So, shareholder appoint an independent third party, which is an auditor. Auditor adds credibility to financial statement because auditor is an expert in finance, an expert in business. That is what you are learning in ACCA, na? So you learn basically about finance, taxation. Basically, you learn about so many things, and then you check those things. And based on your understanding, you provide confirmation to shareholder whether these financial statements are correct or not. You provide your opinion in audit report. This is the entire audit. This is the entire purpose of audit and management stewardship and the agency. I hope this was clear. If this was not clear, do let me know. I'm still available on WhatsApp. You can communicate with me basically if there is any doubt about it. Okay. So this was accountability, stewardship, and agency. In a company, basically the management act as an agent of the body of shareholder. They are accountable to shareholder for their stewardship of entities asset, which are placed under their control. Basically, director have the control of the entities assets, and they are basically responsible for showing the stewardship. I hope the stewardship word is now crystal clear. They achieve this by preparing financial statement. By director basically show their stewardship by preparing financial statement, who are presented to shareholder. Most incorporated entities. Incorporated entities are what? That are registered as per law. So companies is registered as per companies law. Okay. Are legally required to have their financial statement. Just to remind, why law? Why statute? Why basically this Companies Act require company to prepare financial statement? Because companies are prepared, companies are managed by director. There is a basically agency issue, as well as company has limited liability. And in order to basically, balance this power, they basically are required to show financial statement. Okay, this you must have read in the financial accounting or in your business technology. The company has so much power of limited liability and basically separate legal entity. In order to balance it out, they are given the responsibility of preparing financial statement. So law requires them to prepare financial statement because this financial statement will be used by stakeholders. Okay, that whether to do the business with the entity or not. Although these small entities are exempted, yeah, we know that, let's say, not larger companies are required. Not smaller companies are required to basically do their financial statement audit. Auditor must be independent of the entity and they are auditing and seek basically the auditor must be independent Basically, they should be the third party. They should not be related to director. They should not be related to the company. They are supposed to give their independent opinion. If I'm a third party, why would I care? Basically, why would I want to favor the company? So I'm only concerned with my audit fees, my basically practitioner fees. Shareholders have appointed me, and I'm just doing the audit service for them, right? So auditor must be independent of the entity auditing and seeking providing opinion on shareholder as whether financial statement are present fairly. What present fairly mean? That they are correctly prepared. That whether prepared by the management or director are correct or not. Let's say trade receivable, let's say inventory. If these are reported in the management, these numbers are reported by the management in balance sheet, whether these are true or not, whether these are actually existing or not. So this is basically what auditors is trying to check. And why they can check? Because they are financial expert. You have done your financial accounting, so you know how trade receivable works, what is a receivable, what is a sale transaction, how basically there's a age dating report, right? Aging report, age receivable report, sorry. Credit control team, they look after the trade receivable. And then similarly, non-current asset as per IES6, how their accounting happens, how repair and maintenance cost should not be part of basically non-current asset. So this is how you will be doing it because you will be responsible. And now this comes to our last discussion of this chapter, which is external audit. What is external audit and how this goes about? Okay. So just before we start audit, let's do the stakeholder and we'll take a quick break and we'll finish this chapter. Example of stakeholder groups. Shareholder can decide whether to alter their shareholding. Okay, shareholder are the basically one of the stakeholder. Many people confuse between stakeholder and shareholder. See, stakeholder is a bigger umbrella. Shareholder is one of the stakeholder. Okay, shareholder have invested in money and they are basically influenced by the decision. So who are stakeholder? Anyone who is influenced or impacted by decision of company. So they are the basically stakeholder. So shareholder, because they have invested their money in the company. So because any decision made by the company, if increase or decrease the value of shares, then definitely they will get impacted. Employees, they are also stakeholder. How? Because their livelihood, their earning is dependent on the company. They want stability in the company. They want to see the profitability of the company. Why? Because if company is profitable, then definitely their salary must increase. If let's say company is profitable and their salary gets in cut cost, then definitely employees will be angry. So they want to know the profitability of the company. This is a classical case of UK company. I forgot the name. One director basically cut the cost of the company in the name of saving the cost. And at the same time, she got a bonus of let's say $1 million bonus. Okay. So this was heavily criticized by the employee union that what are you doing? At one time you're firing us, one time you're not paying us salary, and at the same time you're receiving $1 million bonus. So how does it, profitability of the company shows? It is not, it doesn't look like a cost cutting. So employees may be eligible to judge whether they think level of pay adequate compared to the director. They may also be interested in the result of the company, as this may impact their employment decision. That if company is profitable, they will continue. If company is loss making, then most likely their jobs will be impacted. Again, management and director, but these are the higher level of employee. They are the one who's running the company, so they want to see the balance sheet, but they are the most close to the process. So they are the one who prepare this financial statement. Okay, definitely their employment is also dependent on the financial statement. That if financial statement shows poor result, maybe shareholder will get angry and they will remove the basically these directors and they will hire somebody else. Customer can make judgment whether company has sufficient financial strength. One example I can think of, let's say Coke company given a 100 crore order to a supplier. Okay, so Coke is the customer of the supplier. Now, Coke company definitely want the supplier to provide this soft drink. Okay, Coke company, let's say, doesn't manufacture their soft drink. They basically hire supplier, third party. So they want to see whether this supplier is able to manage this 100 crore support. Definitely, they will be interested whether the financial statement has sufficient financial strength, they have sufficient assets, sufficient inventory, sufficient machinery, right? Let's say if it's a company with a 50 lakh balance sheet, do you think Coke company would invest them? Definitely not. They would want to invest in a company that has, let's say, at least 50 crore worth of balance sheet so that they can handle this 100 crore of project, right? Or maybe 500 crore company. definitely a strong, basically a company that they want to deal with. So as a customer, if you want to give a big order, just you and me being a customer, we just are concerned with a small product. But mainly the business is 90% business is B2B. So if this business, basically a business to business, when they are making order, they want to show that they receive their order on timely basis because they want to deliver it to their customer, right? Supply, banker, lender, they are interested in basically whether they can give the loan to the company because they will under interest. But what if their capital gets lost? What if they would provide the goods on credit and company basically is not able to pay them on time? So they are interested in financial stability. And it is a very common phrase that bank only provide loans to those people who can afford the loan, right? So this is basically the same thing that banker, supplier, lender, they want to see the financial stability. Their company is able to, take this much loan. And the government has multiple purposes. They want to see the tax, whether how much tax is entity is able to generate, whether they are underpaying their tax. Second thing would be basically, let's say, government is interested in knowing basically whether they are following laws and regulation, whether there is non-compliance. So many things government check, not only tax, but multiple things, laws and regulation, imply any environmental hazardous activity or environmental friendly practices. So as a regulator, as a tax collector, government is interested in the financial statement of the company. So these are the stakeholders. Now, second para is basically external audit, and we will be able to quickly cover because nobody is right now asking me queries. So I will definitely be quickly able to cover. So let's take a 10 minutes break, and after 10 minutes, we'll be basically quickly wrapping it up. Okay, this will be too quick today. So 10 minutes break. So I hope we are back. Now let's understand the audit. So what is the audit and basically what it is about? But now I hope you have got an idea why audit is happening because of the shareholder want to get the credibility enhance of the financial statement. Okay, let's see how it is written. You know, this is what my favorite part is when I asked Vin to read this definition. Objective of an audit. This is as per ISA 200. What is ISA? What is basically international? This is basically the definition of ISA, International Standard on Auditing. What these are, basically, we will be explaining them in class number 3rd and 4th. Okay, in chapter number 2 mainly. What is ISA, why they are there, and what is this number? Do you need to remember them? I have answered all these questions in the upcoming lectures, right? So don't worry them that what is this ISA, why they are mentioned. Just to let you know, ISA is just a best practice of performing audit. International standards on auditing. Like you can see the word standard. Basically, what are the best standards you can follow when doing the audit? Okay, best practice you can follow to do the audit. Okay, so this is essential procedures or assumptions that we follow when we are doing audit. Let's say my way of doing audit is different from your way. So we should be following a standard, minimum standard when we are performing audit. So this is what ISA is reflecting and why these are issued, who issues them, why we follow them as an ACCA. You will basically understand them in the upcoming chapter number 2. So ISA overall objective of auditor, this is defined where the, what is the objective of audit in ISA 200. The overall objective of independent auditor and conduct of audit in accordance with international standard of audit. So ISA as a following definition. Objective of audit. What is objective of audit? Why we are doing audit? Look at this definition. Objective of audit of financial statement is to enable the auditor to express opinion on whether financial statements are prepared in all material respect in accordance with the applicable FRM. So this is my favorite part of this definition. That I don't know why they start with this definition. Like why they would expect a student to understand this definition on immediate go. Like what is applicable FRM? What is all material respect? What are financial statement? Expressing an opinion. But because now we have covered the assurance part, now this will be much easier. Definitely there are still parts, let's say what is applicable FRF, financial reporting framework, I have to explain. But this part should be easy to understand. Objective of an auditor. are to obtain reasonable assurance. What is reasonable? Basically assurance, reasonable one, not limited, but reasonable assurance. So audit is a reasonable assurance about whether financial statement, balance sheet, P&L, cash flow as a whole are free from material misstatement, whether due to fraud or error, in order to enable them to express opinion on financial statement and are prepared in all material respect in accordance with applicable financial reporting framework. Let's break down this definition because I know most of you would not be able to understand. So let's break down this definition. What this is saying. Sorry. See, we understand this financial statement. This is balance sheet, P&L, or cash flow statement, or statement of changes in equity, or basically notes to account. Remember, notes to account is integral part of balance sheet. Always remember that. Objective of auditor is to express an opinion. Opinion what? That whether financial statement prepared by management is correct or not. Okay. But are prepared in all material aspect. This material aspect and is applicable FRF now. Let's understand this 2 point. Material aspect. Let's say SBI is basically a, let's say 10 lakh crore, maybe 2 lakh crore company. Okay, just as an example, I'm not sure about the current valuation. You can go and check. Let's say SBI is a 2 lakh crore or 10 lakh crore, whatever. Okay, and if you know SBI has more than 10,000 branches. Okay, out of this 2 lakh crore, majority of this 2 lakh crore basically consists of, let's say, 150 branches. Just as a hypothetical example, that majority of this 2 lakh crore, let's say 1.5 lakh crore comes from 150 branches. And the remaining 0.5 lakh crore comes from 9,850 branches. Now, definitely, if I check the majority of these branches, I will be able to check the significant portion based on value. That if I want to check 2 lakh crore, if I check this 150 branches thoroughly, and for the 9,850, I don't check them in detail, but get an overall understanding. So not in detail, but it is major detail. So in this case, can I say fairly, I have checked major or material portion of this SBI? Another example, let's say I have a balance sheet. There is non-current asset, current asset, basically property, plant, equipment as a non-current asset. Let's say cash, let's say inventory, let's say trade receivable. Okay, this is 10 crore. Out of 10 crore, 8 crore is PPP. This is, let's say, 1 crore. This is 0.5 crore. This is 0.5 crore. Now tell me, if I'm able to check this item of 8 crore, can I say that I have checked majority of balance sheet? Or giving in more detail, this 8 crore consists of 3 properties. Basically, let's say this 10 crore consists of 50 properties. One property, basically one single property value 6 crore and rest 49 property value 2 crore. So if I verify this one property majorly, can I say I have done basically material checking? So as an auditor, when we are checking the financial statement prepared by management, we will try to check whether financial statement are materially misstated. What this means that as an auditor, we acknowledge that financial statement can have error, can have fraud. So there can be a misstatement. Misstatement includes fraud or error. So when we do an audit, we say that yes, there is a possibility that financial statement will have error. But because we have done audit, we did not find any material error. So let's say in this SBI branch case, one of the branch basically gets a fraud of let's say 50 lakh. But whereas SBI branch has 2 lakh crore to report. Now, do you think if this 50 lakh, let's say not fraud, this 50 lakh was because of error? Now, do you think that if 50 lakh out of 2 lakh crore, 50 lakh is just rupee and 2 lakh crore is the entire valuation. Out of 2 lakh crore, only 50 lakh were misstated. Do you think we should call out the management and say, CC, these directors have prepared incorrect financial statement? I would say no, because you can still verify 2 lakh crore. Basically, if you deduct 50 lakh from 2 lakh crore, it would not basically impact much. And shareholder would not be concerned much. Because shareholder is asking whether materially, let's say out of 2 lakh crore, let's say 1.99 lakh crore is basically okay. Because 1.99 lakh crore is basically higher value. Though we don't want this error, we are not saying we want this error. It's just that we are saying that checking in so detail is not possible. So we check them material amounts. Material amounts. And why we are not able to check basically audit in detail? Audit is a reasonable assurance. You can see that the word is reasonable assurance and not a guarantee. See, if I talk about Airtel company, any telecom company, Airtel company, Vodafone company, okay, or AT&T, so some Indian or some international company. In a single day, they have not million but billion users. Let's say 20 crore, 50 crore, whatever. Let's say 20 crore people. Okay, they are calling each other. They are using internet service or maybe some other paid service. Okay. So one single day, these 20 crore people just call one time and use one internet. Do you think it would not generate less than 20 crore invoices in one single day? One single day. Now, for an auditor, do you think even if you combine all the audit firms in Delhi, they would not be able to check entire 20 crore transaction even in 1 month, even if you combine all the firms in Delhi. So it's very, very time consuming. So what will you do? Instead of checking this entire 20 crore, what you would do? You would check all the material transactions, Okay, this would give you a reasonable assurance. So instead of checking the entire population of 20 crore, auditor would only check a sample. And because they are only checking a sample, in that case, they cannot guarantee, let's say out of 20 crore, they check 1 lakh transactions. Now you might say this 1 lakh transaction are so less than 20 crore. But understand, further we will learn that auditor basically will rely on this system, that Airtel uses, the controls on the system. If you are able to verify the system, you are able to do the audit automatically. So auditor will check 1 lakh transaction. Now what if the error is in the next 1 lakh transaction? So you see the problem. Let's say this is a very extreme example. Another example. Let's say there are 10,000 invoices in a company. Okay. Auditor may check 500, 1,000 or 2,000 samples. Why auditor would not check 10,000 samples, 10,000 invoices together? Well, the reason is auditor is not paid that much. Basically, he has to weigh the cost versus benefit. Okay, whether it is actually, whether it is viable to check all those 10,000 transactions. If we can get a confirmation from checking 2,000 transactions or 500 transactions, what's the point of checking the entire 10,000 transactions? Right? So that is why auditor would check 500, 1,000 or 2,000, maybe a sample of transactions. But there is no guarantee that error would not happen basically on 3,000 transactions. And this is why auditor is a reasonable assurance. We will cover this in more detail. I know you are getting doubtful that why not auditor check entire 10,000 transactions. This we will cover in more detail in upcoming chapters, especially in risk assessment in your chapter number 11. We will cover in so detail. Why only sample basis? But this was just a small proprietor case. But in this case, in a large organization, definitely there are millions of transactions, if not billion. In case of Walmart, Reliance Retail, there are thousands or lakhs of transactions in one single day. Think about 365 days. So checking all these transactions is not possible. And because audit cannot check all these transactions possible, that is why audit is never a guarantee. Another reason audit is not a guarantee. Another reason audit is not a guarantee. That financial statement, those who have learned the financial accounting or financial reporting, they understand that financial accounting also includes estimates, let's say provisions, let's say valuation. And these are basically based on estimates or judgment. And no matter how expert you are in finance, no matter how expert you are in finance, you can never check provision valuation accurately. This is not possible. The word is estimate. You are estimating. How can you know? Basically, for sure, right? You take an advice from an expert. They will also estimate. Let's say an example of cricket, where let's say the cricket expert are predicting based on the weather condition, based on the pitch requirement, based on the overall forecast. They are predicting whether batsman will be playing good or not. But can they guarantee whether batsman will be playing good or not? Because that will actually come to know in the actual performance. So that is why in financial statement we use estimates in provision, valuation. Let's say we have PPE, we use depreciation now. So to depreciate, you need to estimate the life of the asset. Okay. Now, whether this let's say you consider 10-year life, whether that 10-year life will last or not, you don't know. So these are the things that make audit, reasonable, not a guarantee. Coming back. So this material point, I hope this clear that auditor check the financial statement on material basis. Why? Because detailed transition is not possible. And this is the same reason that audit is a reasonable assurance and not a guarantee. Second thing, what is applicable FRF? What is applicable FRF? Applicable FRF. This is also called FRF, Financial Reporting Framework. If you are in UK now, you are supposed to prepare your financial statement as per UK GAAP. What is UK GAAP? General Accepted Accounting Principle. This is GAAP. Okay, this is the definition of GAAP. General Accepted Accounting Principle. So if you are in UK, you are supposed to prepare financial statement as per UK GAAP. What is UK GAAP? In this case, IFRS and FRF. Financial Reporting Framework, basically Financial Reporting Framework. So if I talk about UK company, they are supposed to follow IFRS for UK as per Companies Act 2006. What about India? India basically follows Ind AS or accounting standard. So this is Indian GAAP. That as per Indian General Accepted Accounting Principle, they follow Ind AS or accounting standard. Large listed companies are required to follow Ind AS and small companies are required to follow accounting standard. Okay. Basically, accounting standard is less stringent than the Ind AS. Okay. So this is the basically Indian GAAP as per Companies Act 2013 of India. Similarly, US companies are supposed to follow US GAAP. So as per the US Companies Act, you can see that these companies are required to follow their own countries accounting principles and reporting requirement. Now, one might argue whether they do a different accounting. See, understand this. Debit or credit would never change. If you are in India, if you are US, you are in UK, anywhere you go, debit, credit would never change. Your financial accounting will always be same in all the countries, no matter what. Because it is the principle, it is a scientific principle. You cannot change debit, credit. What you can change is the reporting method. Reporting method. You know what? In India, previously there used to be a T-shaped balance sheet. Asset would come here, equity would come here, and then liability would come here. P&L would be like this: debit, credit. It would be like an account. Sales will be mentioned here, purchase would be mentioned here, and net profit would be mentioned here. This is how reporting used to be. Now, after implication of India follows this T, basically vertical shift, where let's say balance sheet would have assets, then equity, and then liability. Okay, numbers will be reported here. This will be a total assets, this will be total liability and equity. This is a reporting structure. So applicable FRM, applicable accounting principle reporting, applicable reporting principle, applicable financial reporting framework. What is framework? What is the structure? The structure. So UK gap structure, Indian gap structure, US gap structure, Bermuda gap structure, basically Australia gap structure, whichever country you are on, you are supposed to basically prepare financial statement as per applicable FRM, applicable financial reporting framework, structure, reporting standard. Okay. So basically this definition, if you read again, objective of audit of financial statement is to enable auditor, okay, express opinion whether financial statement are prepared as basically prepared by management are correct or not. Okay. Whether financial statement are prepared in all material aspect. I hope now we understand material aspect means not all tranche but material amount. In accordance with applicable FRM, applicable financial reporting framework, US GAAP or UK GAAP or Indian GAAP, whatever. Okay, whichever GAAP is applicable to you. Okay, so as per your country's requirement, management will be responsible for preparing those financial statements, and auditor would check those financial statements as per those applicable requirements. Now, objective of auditor is to obtain reasonable assurance. Why? Because it is not a guarantee, because we are not checking in detail. Sorry, we are checking in detail, but not everything, not everything. And because there is a professional judgment and estimates requirement, so we cannot give a guarantee about that. About whether financial statement as a whole are free from material misstatement. I hope now this is clear. Material misstatement, not misstatement. We are not saying financial statement are free from misstatement. We are saying financial statement are free from material misstatement. Material misstatement. Okay. Misstatement includes fraud or error. So that auditor can express opinion on financial statement, basically whether they are prepared in all material respect in accordance with the applicable FRM. That management has prepared financial statement as per reporting requirement of the country, applicable financial reporting framework. I hope this is clear. This definition is now making more sense. Okay. So this is just a definition. In a company, management acts as an agent, body of shareholder. They are accountable to shareholder for stewardship. They achieve this by preparing financial statement which are presented to shareholder. This financial statement will be prepared as per applicable country reporting requirement for financial reporting framework, and auditor responsibility is to check whether these financial reporting framework are prepared as per those requirements. They are not materially misstated. This is what auditor will check. Okay, not misstated but materially misstated. So we can see that there can be error. Definitely, if we identify an error as an auditor, we will ask management to correct them. It's not like we are going to leave them. But our purpose is to provide opinion on the material misstatement, not the small misstatements. Okay. Now, objective of audit. Again, I have to explain the meaning of true and fair here. It will take again 5 to 10 minutes. And then we will be through with this. Auditor basically objective of external audit is express an opinion on financial statement that give a true and fair view. Now I hope we all understand what true is. True means factually correct. That let's say if sales has happened, if sales has occurred, then this is basically reported correctly. If something is let's say 100 rupees sale, so it's not reported as 200. That's factually incorrect. You are reporting something that is 100 as 100. Okay. As per applicable accounting standard, relevant laws, you are reporting it correct. That is true. We all understand what is true. Okay, that there is no lie, no basically misleading information. Sorry, no lie, that is true. But what if it is fair? Fair means that something that is impartial and unbiased, means that is something that is not misleading, and represent commercial substance of the organization. Let's understand them. Basically, let's understand this one. Those who have covered financial reporting, this is to them. Okay. Let's say I take a lease of 10 years. Okay. Those who have covered financial lease, they would understand this example. If I have taken a financial asset for 10 years, so in that case, I'm not going to show them as rent expense debit to bank of cash. Okay. This is not the entry I would do. I will create a right of use asset, and basically this will be showing in my basically books, and I will depreciate this right of use asset over the life of 10 years. Similarly, I will create a financial liability, or sorry, a lease liability as per IFRS 16. Okay. This right of use asset and this lease liability is shown as a commercial substance. As a commercial substance. What is commercial substance? Let me show you. Basically, not showing this expense, but rather showing this as an asset and lease liability, and then amortizing this lease liability as an expense, and this basically charging this depreciation. Instead of this rent expense, a depreciation expense and a finance expense. Now, those who didn't get his example, don't worry. Let me give you another example. Commercial substance. Let's say I'm Mr. A. In my balance sheet, I bought a property, let's say of 10 crore. Okay, this is property coming in the PPE. If you follow the cost model, I'm always supposed to report this 10 crore in my balance sheet. Now I need to basically inflate my revenue. What I will do? Basically, this property, let's say, is at location. Okay, this is my property, and there is a similar property, exact size, exact figure, nothing. It's just that this is my property and this is the property of Mr. B. And he has also purchased this property. What will happen? Let's say 15 crore. He has bought some other time. Let's say his property is 50 crore. Now what I will do, I will go to Mr. B and ask them to sell his property to me, and I will sell my property to him. What will happen? I will show property of Mr. B. Now, the market price of both these properties is 100 crore right now. What I will do? I will say I will have bought the property of Mr. B of, let's say, 100 crore. I have sold my property of 10 crore. And how much property have I made? I have made the profit on sale, 90 crore. Now suddenly a new picture would come. My balance sheet would show a property of 100 crore and my profit and loss would show a gain of 90 crore. But do you think anything has actually happened? These are same property. What you have done? Just exchange of property. Though this is a transaction, definitely a sale and purchase transaction, but there is any reality of this transaction, whether in substance or in reality, this transaction has actually occurred. Answer is no. This was just on paper. This was just a formality. This was just in form, not in substance. So in reality, this property got exchanged. But there was no commercial viability. If let's say you and I get into a transition, I am providing you a teaching services. So you're paying me for that teaching services, right? Right? So you basically give me cash, you give me money, or you give me something equivalent for that. That is why you are basically taking my audit services. Let's say you come to me, you provide me same audit lecture and I provide you same audit lecture. Do you think anybody would do that? So why they would basically exchange? Just to inflate their balance sheet. So this is something just on paper, just to increase the value. In reality, nothing has happened. And similarly, we do this accounting. Leases accounting. Why? Because in reality, the asset have been used for 10 years. So let's say asset has 30-year life. So in this case, 10-year life belongs to me. I'm just showing this as a rent expense and creating a off balance sheet item. This is not I'm showing in my balance sheet, because if I show this as an asset, I also have to show that for 10 next year, I have a liability to pay. Right? So this is why we do introduce IFRS 16, we do the substance accounting, commercial substance accounting, that what is happening in real. Another example, financial instruments, if you have studied financial instrument, where if you issue redeemable, if you issue convertible debenture. So many people would know now this debenture is normally a loan. Debenture is normally a loan, so it should be shown a liability. But in substance, if this debenture would be converted in equity, so some portion should be going on to debt and some portion should be going to equity. So we should show the transition in its substance, in its real form, not in its basically paper form. So substance over form, substance over legal paper. So we should see the real picture instead of just the legal picture of the basically of the instrument. And this is what it is saying, that fair transaction should basically provide the information which is providing a commercial substance, not a misleading information, not an basically not a biased information. A fair. Let's say if I ask you that whether you let's say you are working in office and you ask your boss that okay, we need a leave to take a class. Okay, it is my class, you're coming to my class to take and you need to take a leave, and your boss grants you this leave. Somehow my health basically deteriorate and I tell you that okay, the class will not be happening today, and now you have the entire day for you. So what do? You go in your theater, you watch the movie, and by chance your boss was also there, he also saw you. Next day your boss asks you basically whether you went to the class. If you say the truth, yes, you went to the class, you came to the class, but actually the class didn't happen. But was your answer fair? If your boss asks you that whether you went to the class, answer is true that you went to the class. But did you attended the entire 3-hour lecture? Was the question. But he basically asked this question, so you replied in truth. But did you reply fairly? You just replied biased. You just only provided the information that was favoring to you. You did not provide an unbiased opinion. You did not provide the commercial substance of the transaction. So this is fair. So I hope now this is what now we understand that when we basically say that audit of financial statement are fairly presented, it means we are talking about that financial statement are presented true and fair view. What is true and fair view? That they are correctly factually basically presented and they are fairly presented. No misleading of information. No, basically showing property exchange and basically inflating your revenue. No, this is not allowed. Okay, because it's not fair to the user. User would think, okay, company has so much revenue, company has so much assets, but in reality, these assets were existing from the beginning. This is nothing new. Okay, prepared in all material respect in accordance with the applicable FRF. I hope now this line is clear. Financial reporting framework to be applied will vary from country to country. That we know, US GAAP or UK GAAP. Okay, and is assumed that international financial reporting standards are the basis of preparing. In our syllabus, when we will be studying, we will be assuming that IFRS are the ones that are the applicable FRF throughout the syllabus. Okay. So true and fair, I hope is we are clear. We are clear with the applicable FRF, and I hope this definition is no more challenging to you. Oh, sorry. This definition of objective of auditor. Now you can understand. Objective of auditor is obtain reasonable assurance about whether financial statement are prepared as basically as a financial statement are whole, free from material misstatement, not misstatement, but material misstatement, whether due to fraud or error, and basically enable auditor to express opinion on financial statement that are prepared in all material respect, basically materially as per financial reporting framework. So means financial reporting framework can be deviated, but not materially. So that is the objective of auditor and objective of audit. Now, basically, director are steward. Basically, they are supposed to show the stewardship. They are the agent of the shareholder. They are basically responsible for managing the company. They are supposed to show the stewardship by preparing financial statement. Auditor comes and check financial statement whether they are prepared as per applicable financial reporting framework, financial reporting structure or format of applicable FRF, UK GAAP, Indian GAAP, US GAAP, whatever, and see whether these financial statements present give a true and fair view. They are factually correct and they present fairly, show the commercial substance and unbiased view. Okay. This is true, this is fair. Presently, auditor's opinion enhances the credibility of financial statement by providing reasonable assurance that financial statements are true and free, basically true, free from material misstatement. They provide a reasonable assurance of high level. Audit is a reasonable assurance because we cannot check everything. We do sampling and then there is a judgment or estimates involved. So that's why auditor cannot give guarantee. Audit is not a guarantee. I hope this is clear. Now, this is the last piece and we are through with this chapter. Oh, there is limited, basically limitations of audit of materiality. So let's first of all cover this audit of materiality and this is the materiality definition. Materiality, basically anything that can influence the decision of a user. Materiality should be defined as anything that can influence the decision of a user. Let's cover this. Materiality is an expression of relative significance or importance of particular matter in context of financial statement as a whole. A matter is material if omission or misstatement would reasonably expect to influence the decision of user. Basically, if I am a shareholder, let's say there is a case, there is a company A, company B, both have a 10 crore value. Okay, just a second. There is a company A, let's say company A, company B. Both have 10 crore value. As a shareholder, as a basically supplier, as a customer, I should be indifferent to both companies. Okay, unless other things remaining constant, we should be basically impartial to both companies. But just one information, basically this company B has a pending lawsuit. Okay, just this information. Though this lawsuit whether would win or not, we don't know. It's just that this is an additional information. Now tell me, suddenly a decision to invest, suddenly a decision to interact with the company will change. So this information is material, means this was able to influence. I'm not talking about the amount. What is the amount of lawsuit? I'm just talking about that this information was material. So material can be in by nature or by amount. By amount. So in this case, I would not invest in this company because there is a information which influence my decision. So anything that influence, that basically whether missing of the information or incorrectly reporting that information influence my decision of using that financial statement. I'm using that financial statement, information comes to my knowledge, then I will change my economic decision, whether to invest, whether to give loan, or etc. etc. So this is basically material. I hope this is clear. Again, this is the definition of reasonable assurance is not 100% guarantee. Okay, that financial statement are materially misstated, but a reasonable assurance. It is the highest level assurance that an auditor can give. Okay, remember there is a further level. Sorry, the windows no India. Okay, so reasonable assurance. Let me come back. Reasonable assurance is not a guarantee. It's the highest level of assurance. If you want to go into deeper, then you need investigation. And investigation is done by regulatory authorities. Let's say CBI, FBI, CIA. These are the entities that do the transaction by transaction checking. These are very super authorities. Okay. They are the next level of audit. They do the investigation. Investigation is the next level of audit. So when we talk about audit, audit is a reasonable assurance. We cannot check each and every transaction. Okay. Now, before we move ahead, this last topic, limitations of an audit. Financial statement includes subjective estimates and other judgment that I told you that because of the estimate, because of the judgment, we cannot give a guarantee. Internal control may be relied on which have their own inherent limitation. This is basically detailed discussed in chapter number 10. Oh, sorry, chapter number 10 or chapter number 9. Basically, the controls, let's say Airtel system, which we will basically verify, we will basically rely on the system itself. So if system is itself faulty, then auditor may not be able to check transitions. Auditor may not be able to, check the accuracy. So internal control have certain inherent limitation. I have given basically Satyam case example that in Satyam case, uh, basically what happened that Satyam case that the director basically overridden the controls. Director were the ones who basically override the control of HR and they were the one who basically entered the fake employee. This is a Satyam famous case of India. So if this happens, then internal control may not be effective to prevent any fraud or error. Manager may have to rely upon only source of evidence in some areas. Evidence is persuasive, not conclusive. It's a very, very important term. That when you get an evidence as an auditor, it doesn't guarantee that it is true. Okay, evidences are basically persuasive, not conclusive. Let me give you an example. This is a famous movie example. In a movie, let's say a hero goes to a villain, basically, telling the villain, let's say Mr. Hero goes to a villain. Okay, Mr. Villain. And he tells the villain, okay, see, I will forgive you for your past debts if you discontinue your, basically your way of doing villainy. This is a night scene, dark and raining happening, typical Indian movie scene. What happens? This villain is showing the back. Okay, the hero is on talking for long hours, but he can only see the back of the villain. Suddenly, when he goes to the villain and saying, why are you not seeing? Suddenly, the body of that person collapses, and the hero sees that it is not a villain, but it is a victim. And the victim is stabbed. And by some logic, this hero decided to, get the knife in his hand, basically pulling it out from the victim's belly. I don't know why, what went into his head. And at the very same time, police arrive. Police sees the knife in the hand of a hero and think, okay, this person has a knife. The victim is stabbed. The blood is there. The blood of that knife, basically blood of the person is on the knife. That means this hero is the one who killed him. So if let's say in the court, if the advocate asks the hero, okay, did you pull the knife out of the basically this victim? So hero would say yes. So in this case, this would be persuasive that yes, this person has killed the basically he's the murderer. But in reality, this is not a conclusive evidence. So this is one of the limitations of audit that once I know this is a stupid example, but I hope you get it, that the evidences we get when we are doing audit, they are persuasive. They cannot tell you 100% guarantee that transactions have actually occurred. See, evidences are about past events or transactions. So past is past. You were not there when these things happened. So you cannot tell for sure. So evidences are always persuasive. And because we do sampling, we don't do 100% testing. So that is another reason of inherent limitations of audit. Okay. Limitations of audit. Audit requires judgment. All this is basically in chapter number 6, chapter number 20, we will be discussing risk assessment. Audit report has inherent limitation. There's a standard report. Layman may not understand audit jargons. It took me entire class to make you understand what is, assurance, what is basically, financial reporting framework. Think about a common person. They would not be able to understand. Audit report can be issued for a long time after the end of the reporting period. Let's say the period is January to December. Okay. And we now have to audit. We now have to audit basically this January to December 2024. So the audit report will not be issued by the end of the December. Audit report would be issued by March or by June 2025. It takes time. So whatever is happening in the organization, it may not be reported on the same year or on the same time. It's not a real-time day basis thing. It's a basically event that has happened, and after a year, we basically report on it. So audit report may be issued after a period where this is no longer, relevant. Okay. So let's say a fraud happens. So in this case, if the event has already happened and now you're reporting it after 1 year, how is this relevant anymore? So audit report can be issued after a long time after the end of the reporting period, whereas shareholder could have taken action had they known it. This is one of the limitations of audit. Some audit evidences indicates what is possible, not certain. Basically, they are persuasive, not conclusive. Because of estimate, judgment, intention. Auditor can never certify that accounts are correct. They can only express that yes, they believe that the account seems okay. Limitation of audit, limitations of control. They can be transactions, non-routine, human error, possibilities of collusion among the employee, cost benefit analysis possibility. We will be discussing them in detail in chapter number 9. Don't worry. And not all financial items are tested, basically 100% sample. So you can see that chapter numbers is mentioned because we will be discussing them. This is, some of the topics of audit which we will discuss in the upcoming chapters. So if you don't get it, don't worry, we will be covering them. By the end of this syllabus now, chapter number 1 should be crystal clear to you. If any point is not clear after covering chapter number 20, after covering the entire syllabus, that means there is some fundamental problem. Okay, there is some fundamental concept clarity required. So all these things should be cleared after we basically complete chapter number 20. And that's why I would recommend once you complete this, please come back and review this chapter number 1, whether you are not able to understand anything. This will show your level of understanding. Now, we have discussed about audit basically objective, what auditor reports on, what is shareholder, what is stakeholder, what is director, what is agent, what is stewardship. Okay. And assurance, basically. This was the chapter number 1. But one last piece. We have said it again and again that a practitioner would basically obtain sufficient appropriate evidence and express an opinion. Express an opinion. They will express their opinion in a report. Let's see how these reports look like, which practitioner reports. Let's see how this report look like, which auditor provide to shareholder. Okay, the auditor provide to shareholder. Okay, about the director's financial statement. So let's see that. This is the last piece, and with this, we will be through. This is just a review engagement, another example of limited assurance. Please read them and let me know if you get any doubt about it. Audit is an example of statutory, audit is an example of reasonable assurance. Review engagement is a limited assurance. We will review any process, any control, any cash flow forecast to see whether they are reporting correctly or not. Basically to see whether there is any mistake or not, particularly. So that's why it's a limited assurance. So read them and let me know if you don't get anything. Final piece. Forming an opinion and reporting on financial statement. Once we complete our chapter numbers 18 to 19, we are able to obtain sufficient appropriate evidences. And based on that, we will conclude that whether directors prepared financial statement correctly. And this we will report in our report. This we will basically show to the auditor in our audit report. So let's see how this report looks like. First of all, there will be a title, and this title will indicate independent auditor report. This is very, very important. Title should always basically show independent. Independent means that we are unbiased. We are third party. We have no relation with the director. So we will report things as is. We will not, manipulate them. We are independent people. And who we will address this to? We will address this to shareholders or known as members. Okay. So if it is written members or shareholder, please understand this is one and the same thing. That please shareholder, you guys are the one who appointed us, because shareholder are the one who appoint these basically auditor. So they basically reported to the shareholder. Shareholder, this is our report. This is our independent report. Okay. The first thing you will start with is your opinion. Okay, nothing formal. Everything you will start basically, you will tell whether financial statement, balance sheet, P&L, cash flow statement, statement of changes in equity, or basically notes to account, whether these are prepared as per applicable FRF. They represent true and fair view. Okay, how will you define this? You will define it basically two formats. You will show unmodified opinion, unmodified or unqualified opinion. In audit, it's a good thing. Management want unmodified, unqualified opinion. I know you are basically looking this like unqualified. This doesn't look right, but this is how we show it. That unqualified and modified opinion that management have presented to and fairly. If there is anything wrong, then we say no, we modify our opinion or we issue qualified, adverse, or disclaimer. Okay. Qualified opinion, then 90% of the financial statement is okay. Majority of the financial statement is basically incorrect. 10% is incorrect. Here in qualified, we say 10% is incorrect. In adverse, we say majority of the things are incorrect. Management has prepared a very bad financial statement. And disclaimer, we resign. We say we are not able to check anything. We will just say, okay, that we were not able to identify anything, so we will just resign. So this is basically discussed in detail in chapter number 20. Okay, so auditor will issue two type of opinion, unmodified or modified opinion, unqualified or basically these categories. This all categories come under the modified opinion. Okay, so auditor will express their opinion on these financial statement prepared by the entity and express their opinion based on the sufficient and appropriate evidences. This is what auditor will do. Okay, next piece. Auditor will basically talk about management responsibility. Let's see, we are just a third party. We are just a third party. We are there to check accuracy, basically fairness of financial statement. We are not the one who prepared it. It is the management who prepared it. So it is their responsibility to prepare financial statement. Okay. This is a long para. We will discuss them how if we are not able to identify any error, this was not our mistake. This was a mistake of management. They are the one who's responsible. Then we will talk about our auditor's responsibility. Our auditor's responsibility. That we are the auditor. We are responsible for expressing opinion, like we express our opinion here. And then we are supposed to follow ISS. Discuss in chapter number 2 in detail. What is ISA? We are supposed to follow ethics. Okay, chapter number 5. Basically, what is ethics? Chapter number 2, chapter number 5. And we will basically use sampling. We will not be able to provide a guarantee. There will be chances of error or fraud. So this is a kind of a disclaimer by auditor to shareholder or other stakeholders. Let's see, we are doing an audit. We are trying to provide a reasonable assurance, but we are not providing a guarantee. And they will also mention, other things like basically risk assessment process, that basically how they obtain evidences, any challenges faced by them. Okay. There will be other paragraphs, let's say key audit matter, anything that was significant, EOM, emphasis on matter or other matter paragraph. They will also talk about, if they modify, so any basis for opinion. Okay. So there will be multiple paragraphs and we will define them. These are, structured format, a well-prepared structure format, which we are supposed to follow. And this structure is given in ISS 700. We will follow the format of ISS 700. What is ISA? What is ISS 700 format? Discuss in the upcoming chapters. Okay. So just look at one audit report with me and then we are through with this class. This is auditor's report. This is given ISS 700, that how auditor will issue their report. So you can see this is an example where auditor is issuing unmodified opinion. Unmodified opinion means that auditor is saying that the report is okay. This report is good. So heading is independent auditor's report, the title of the entity, and they address it to the shareholder. Now they start with their opinion that we have audited this company, and according to us, the financial statement present in all material respect give a true and fair view. Means first thing we started with our opinion. We told that everything is correct. We told like what we audited financial statement includes, financial position, statement of financial position, which is the balance sheet, statement of comprehensive income, basically the P&L, statement of changes in equity, statement of cash flow, and notes applicable to it. Okay. Then what was the basis of our opinion? Our base is basically using ISS, ethics, the evidences we obtained that we are supposed to follow ethics, everything covered in detail upcoming chapters. Whether there was any matter which we think was significant, which we want to basically show that these are the significant area which required, so much effort from us. Management responsibility or those charged with governance. TCWG, those charged with governance, another name for management. When we talk about board of director, we talk about those charged with governance. Okay, when we talk about lower level management, we talk about management. Okay. So responsibility of management of those charged with governance, that they are the one responsible for preparing financial statement, our responsibility. Now, I will not discuss auditor responsibility right now because again, this is a revision. If you want to revise your audit chapter now, just go back and read auditor's responsibility. There is so much in auditor's responsibility. Okay, definitely I have covered this in the upcoming lectures. So please go through them. Especially after chapter number 6, now go through this auditor's responsibility. This is a much detailed version of auditor's responsibility, and you'll be able to understand them very much after you cover chapter number 6 and 7. Okay, so please wait till you cover auditor responsibility, but I have already told you what this basically paragraph is talking about. Auditor responsibility is about the financial statement, expressing opinion thereon. They cannot confirm that audit is, free from material misstatement, and that there is a fraud and error possibility, there is a risk assessment, there is an internal control testing, so much and so forth. Okay, don't worry, you don't need to understand this right now. You will be able to understand it basically after you complete at least chapter number 6. Okay. So that's it. This was your chapter number 1. I hope you were able to understand this. Let me know if you get any query. I'm available on WhatsApp. You can just text me and let me know if you have any query. If possible, we will also connect on the call. But please text before you ask any, you directly call me. Okay, so this is basically element. This was one activity, and I think we have covered the chapter number 1. Yeah, it is covered. This is your summary. So that's it for this basically section. In the next class, in the lecture number 3, we have also discussed about chapter number 1. So if you want, you can skip those part, or if you find it relevant, you can continue. Okay, not much. In the second lecture, we started with the chapter number 2 already. So this was the chapter number 1. I hope this meets your expectation and your requirement. Do let me know in case of any question. So thank you for attending this lecture, and bye bye.